today I want to run you through what are some of the reasons why you should be investing in property right now and what the perfect property actually looks like. So let's kick things off. I guess the first thing I want to run you through is property prices have actually doubled every 8.5 years over the last 6 decades. So if you're looking for an asset that's going to be compounding and growing your wealth over a period of time, it is the most safest asset to park your money. And when we compare the market here in terms of where is wealth distributed here in Australia versus comparison to some other markets, you can see over 80% of the wealth here in Australia is actually parked in the property market. It is why over 50% of the wealth distribution in the country is in property. And historically speaking, it is the most stable asset class to invest your money. What I want to walk you through is, I guess, why is that the case? And let's get a bit of a comparison going when we compare share pricing to the property market. So first things first, we've got Qantas. They've been in the news recently. Well, over the last 6 months, they've had a correction of 14%. Now, even in the GFC time, when property prices corrected here in Australia by a whopping 7%, you wouldn't have seen the bloodbath that's happened in the Qantas saga. We go, well, Qantas, maybe that's just a red herring. Maybe there's not many more like it. Okay, well then let's move on to the Bank of Queensland. The Bank of Queensland, even with rising interest rates, they've had a negative 17% drop over the last year. We then move into, okay, well, surely that's the worst of it. Domino's. Everybody loves a good Domino's late on a Friday night. Well, they've dropped by 21% over the last year. We can then go into the Endeavour Group. If you're not familiar with the Endeavour Group, they own places like Dan Murphy's, a lot of hotel establishments, etc. They've taken a hit of over 27% over the last 12 months. And then ZipPay, if you know ZipPay, Afterpay, that kind of same setup. Well, they've only had a minor correction there, just a mere 70% correction over the last 12 months. So that kind of instability, which you see in the share market, which you see in your cryptocurrencies, that doesn't happen in the property market. The property market, not only is it of low supply and high demand, you're getting yourself into assets which have a returning income. You've got your tenant in there paying their rent, contributing to the outgoing costs of keeping that property afloat. And the other thing that's really powerful when it comes to property is the power of leverage. So when you're getting into the power of leverage, what we're talking about here, I guess, well, let's have a quick look. So if you go out there and purchase a property today and you put $1 million down, you can make it a cash purchase, and let's assume we get a 10% return. Well, your return on investment has been $100,000. So your total return has been 10%. But if we flip that around and we talk about leverage, so we go out there, we get an 80% loan, and we only put $200,000 down to make that purchase, we still get that 10% return. We're getting $100,000 return on our money. We've actually had a return of our investment of over 50%, or at 50%. So you've 5x'd your return on your investment with a far less significant stake to put down. So you're actually mitigating your risk at the same front. So that's why property has always been and will continue to be the fastest grower of wealth with the least amount of risk out there, assuming you're out there purchasing the perfect property. So I guess firstly, what does the perfect property look like? So firstly, you want to be buying in an area where demand is greater than supply. You don't want to be rushing out buying assets where there's a whole land development about to be released, or there's hundreds and hundreds of apartments going to be released into that area, because again, supply is going to be outstripping demand. The second thing you don't want to do is be buying the ugly duckling on the street. Even if it's saving you $10,000, $20,000, going out there buying a property which is going to be in little demand from a renting or a buy perspective is going to hurt you in the long run. We want to buy a property that is at the highest point of demand from a rental perspective and a buying perspective. Don't go out there and buy the only weatherboard home in the entire suburb just because it costs you a little bit of money. Or don't go out there and buy a property that's sitting in front of the school entrance, and at every day at 9 a.m. and 3 o'clock there's dozens of cars parked at the door. That is not the way to go about it. And then the final point is you want to make sure your property has multiple exit strategies. And what I mean by that is, if your property is focused on these three key things. The first one being capital growth. We talked about leverage. Leverage is the most important. If your property has strong capital growth coming to it, not only are you going to be growing your wealth, there are multiple exits out of that strategy in terms of whether you're selling down for profit, whether you're extracting equity, whether you're using that to purchase another property, whatever it may be. That's exit strategy number one. The second one is it producing you good cash flow returns? Now, that might not happen at year one, particularly in the current segment where you're paying 6% interest rates or more. You might not have cash flow today, but if you're buying in an area with good, strong rental returns and they're trending upwards, that property will be putting money in your pocket eventually. And then thirdly, is you want to have value add potential. So if you're going out there, you're buying properties that are apartments or you're buying a small unit, there is little value add potential you can do to that property. Yes, you might be able to do a cosmetic renovation in the future, but if you're buying a property that's a standalone dwelling, the exit strategies out of that property can be exponential. You could do a cosmetic renovation today or in the future. You might do a subdivision in the future. You might add a granny flat. You might turn it into a share home. You might do turn it into an Airbnb. The possibilities can be endless, but ultimately, if your situation changes, if today you're using that property purely for tax depreciation benefits while you're on your high income, that's fantastic. But if down the track you lose that job and you've no longer got the depreciation benefits to cash in on, well, if you don't have those exit strategies on that property really isn't working for you anymore. Guys, my name's Julian. I'm the head of strategy here at Ripe House. If you do have any further questions in terms of what the perfect property looks like, please feel free to leave a comment below. Also, feel free to click on the link where you can book in a time for a brief consultation to talk about your property investing goals. Also, make sure you're following me on LinkedIn. I'll be delivering a bunch of new investment data criteria projects coming through there. And we also have a big project coming in the pipeline over the next couple of months. Make sure you like and subscribe, and I'll catch you both in the next one. Bye for now.